Good afternoon. Good afternoon. It's Monday, the 21st of July. Welcome to another edition of Monday Market Picks. My name is Silan Wickramasinghe, the head of research for Maybank Securities in Singapore. 11 days. That's the winning streak that the STI has had, and we haven't seen that in 20 years. So this is a very, very significant moment, I think, in history. And we're also getting closer to the MAS releasing their first set of fund recipients who will benefit from the EQDP program as well. So what's next for the STI and for stocks on Singapore? Well, that's what we're going to be speaking about today. We are specifically going to be focusing a lot on stock picking as we go to the next phase of growth for SGX. So that's what we're dedicating our show today. We'll be speaking to Hussaini, who has got a string of initiations out specifically on Sheng as well as on THBEV. And also we'll speak to him about what he's expecting on Grab as they release their second quarter results later this month. We also have Krishna riding with a data center initiation with Keppel KDCREIT. We'll ask him what he thinks about this stock and whether it can go any higher. And we also have Jarek turning bullish on two stocks as well, Frencken and CSE, and we'll find out the reasons for that. Plus, we have some fresh new ideas from our chart guy as well. So without further ado, let's first talk to Hussaini. Hussaini, thanks for joining the show.
Yeah, hi Thilan.
Okay, Hussaini, now you've initiated on Sheng, which is Singapore's second largest retailer with a buy. It's got about a 3 billion Sing dollar market cap. And we actually think that this could be a candidate for this EQDP funds when the MAS releases those funds to fund managers, external fund managers soon. So let's start with that. Hussaini, what's driving your bullish view on Sheng?
Sure, thanks Thilan for having me. So we expect the medium-term growth for Sheng to be above trend. We expect revenues and earnings to grow at a CAGR of 6% and 8% respectively over the next 3 years. And the key drivers is that its key competitor, Sheng Siong's key competitor, Giant, had been rationalizing its footprint in Singapore, which in turn is helping Sheng Siong. So Giant and Cold Storage, which is owned by DIF, is recently being sold to a Malaysian startup called Macro Value. And looking at Macro Value's funding as well as its strategy, we expect Giant rationalization to continue. Okay. And based on our proprietary analysis, location-based analysis, we are of the view that if Giant rationalizes or shut down, then it helps Sheng Siong much more than, or 68% probability that it helps Sheng Siong, then it helps fair price. So we are of the view that as Giant rationalizes under new management or under new ownership, then it helps Sheng Siong, and that drives our above trend revenue growth for the company. For this year, we expect company to add 10 new stores, which is more than 10% of its overall footprint in Singapore. And in the next 2 years, we expect 5 to 6 new stores to be opened. That's point number one. Then the second point is that factors like online grocers as well as people eating out, all these are very mature in Singapore, and those are no more a factor. Means what we analyze based on our analysis, the online grocer pricing are almost 10 to 21% higher than that of what you find in Sheng Siong's store. So Sheng Siong is competitive, those trends are mature, and given the rationalization of Giant, we see an above trend growth for Sheng Siong.
Okay, but now Hussaini, one thing that I kind of notice is the valuations are already at a premium. I mean, this is not a cheap stock. It's already run about 40% in the past 12 months or so. So how would you respond to that?
Yes, means I agree that the valuations are bit on the higher side. It's trading at 21 times price to earnings ratio for this year, and that is around 0.7 times higher than its long-term mean. But given the fact that the company's growth trends looks much more positive, we think that a premium is warranted. Means look at the other consumer names in the region. They all are in a way they are kind of facing growth challenges, which is not the case with Sheng. Growth is much more defensive in our view. And the second factor is it's a net cash balance sheet and around 5 to 6% free cash flow yield. That translates to its 4% dividend yield. So in our view, that 4% dividend yield is also very defensible in nature.
Got it. So you got a mature market like Singapore, but still a stock that's delivering high single digit sort of growth, plus a decent dividend yield as well, and a cash balance sheet. So quite interesting, I think, as a stock, particularly with the MAS funding coming in as well. Now, I want to turn my attention to another stock, which is THBEV, which you also initiated on. Now, this is a large cap index stock, has about a market cap of around 12 billion Sing dollars. But you've unusually initiated with a neutral on this stock. Why?
Yeah, sure. See, the key reason is that we see an overall growth softness for this company. No question, valuations are cheap, but we see multiple areas of growth softness. So maybe just a bit of perspective is that Thai Beverage is one of the largest alcohol company in Asia. They are number one in Thailand and number two in Vietnam. Okay, now both these markets, Thailand and Vietnam, have very high level of per capita alcohol consumption. Okay, so actually it is 2 to 10 times more than other emerging Asian markets in terms of alcohol consumption. So Thailand and Vietnam are very high. On top of that, in Thailand, we see macro softness and tourism softness, and those two are highly correlated, driving alcohol consumption. So those are the factors which are kind of weighing down on the growth. In Vietnam as well, there are factors like higher consumption taxes, which is expected to go up from 55% to 90% by 2031, and there are also stringent drink and drive regulations. So all these factors are going to weigh on the growth. We expect volume growth of just 2% without any price increases, and that translates to around 3% in earnings growth, given a limited operating leverage is there. So all in all, very soft growth trends. The second factor is that company's balance sheet is also stressed at around 3 times net debt to EBITDA. So in the event, if the growth falters for one or the other reason, then the dividends could also come into questions. So those are the factors driving our neutral call.
Got it. But what would you need to see to change your mind and turn this call into a buy?
See, one of the key catalysts on the stock, which to an extent is also downside support in our view, is that company is looking for IPO of its beer business, the beer business in Thailand and Vietnam combined, as well as its non-alcohol business, which is mainly FNN. It's a listed company in Singapore. So if they go for an IPO of these two companies, we are of the view that it could help it could help to unlock value. So based on our analysis, if they go for a beer co IPO, and assuming that the beer co could fetch the same valuation as its regional and global peers, then we see a overall Thai beverage level upside of 5 to 12%. Similarly, if they go for an IPO of its non-food business or non-alcohol business, I mean to say, then we see an upside of 2 to 6%. So any movement on those initiatives like the IPO of beer co or the non-alcohol business, then that in our view would be a catalyst, and at that point we could change our mind.
Great. Thanks, Hussaini. Now, but before I let you go, let's talk about Grab as well. Now, they're releasing their first half results on the 30th of July. We've got a buy on this stock. What should investors expect?
Oh, yeah. We expect a very stellar growth from Grab as they release on 30th of July. We expect their on-demand GMV growth of 20% on a year-on-year basis. And that mainly driven by food delivery. So food delivery, if you see, had been bit soft or quite bit soft in the last several quarters, but now it is picking up. And for this quarter, for the second quarter, we expect it to grow at 21% year-on-year basis. So a big comeback from the food delivery business. And at the same time, the mobility business is also expected to remain strong at 19% year-on-year growth. One more important thing to note is that Grab is increasingly focusing on affordability, and that in turn should allow them to take market share. Not to mention is that competition remains quite rational. So multiple things are ticking up for Grab at the same time. Now on their financial services business as well, we also expect a stellar growth in the second quarter. We expect their loan book growth of 79% year-on-year and 25% quarter-on-quarter. So in general, we expect very strong growth. There will be some increase in cost because they are pushing for more affordable services and more loan book growth. So we expect margins to come down a little bit, but again, I don't see that it is a factor of competition. It is more of a factor of that they are opportunistically taking market share based on their affordability drive. So net, we remain very positive on Grab and maintain our buy.
Got it. Thanks, Hussaini, for that. Now, let's turn to tech. Jarek has been negative on this sector given all the tariff uncertainties, but he has just upgraded Frencken target price by around 30%. And here's why we think that investors should take notice. Valuation gaps create opportunity. Frencken trades at about 14.5 times 2025 year-end PE, which is a steep discount to peers like UMS, which is at about 21 times, AEM, which is at about 23 times. We see this gap as unjustified, especially with a re-rating catalyst coming, which, as we all keep talking about, is the MAS EQDP program. Now, there's also new Singapore facilities which can boost growth as well as margins. They're expanding into larger clean rooms in Singapore, unlocking capacity for key semiconductor clients. This move positions Frencken to scale efficiently with better margins thanks to lower production costs than Europe. There's also tailwinds from US-China policy as well. Potential rollbacks from the Biden-era semiconductor export restrictions could actually reignite demand. Frencken's clients, especially in Europe, stand to benefit from this, which in turn means more project flow for Frencken. Now, this is the top pick for our tech sector in Singapore, improving margins, a solid pipeline, and undemanding valuations that keeps this stock as our top pick in the tech space, riding this semicon recovery cycle. Upgraded valuations, even with this 30% uptick in target price, is justified. When you look at our target PE, it's about 16.3 times, which is not particularly a stretch for our 175 target price. So do have a look at Frencken at these sort of levels. Now, Jarek's also reiterating a buy call on CSE Global. This is why we think the stock got even more attractive. Order wins are driving better visibility. They've secured about 294 million Sing dollars of new orders in the first half, led by infrastructure and oil and gas segments. This sharp uptick provides clear revenue visibility going all the way to next year. Now, margin expansion is also underway. EBITDA margins rose to about 10.6% versus about 8.6% before, thanks to improved execution and operational efficiencies. We see there's further upside as cost discipline also starts to play off. Recurring revenue also strengthens their business model. About 38% of revenue is now recurring, giving CSE a lot more earnings stability. Plus, and that's really a plus during these uncertain macro conditions. There's also healthy cash flows supporting dividends, robust operating cash flows of about 28.2 million, and a net cash position means that there is sustainable dividend payouts. Again, something that will appeal to a lot of our yield-focused investors. And valuations are still undemanding. It's about 11.2 times earnings. That's trading below peers. So all of this justifies our buy call and our target price as well. Now, with that, let's turn to Krishna, who's initiated on Keppel DC REIT. Now, as far as REITs go, this has been a very strong performer with the stock up about 10% in the past 3 months. Now, Krishna, before we go on to the investment call, can you give us a little bit of background on KDC REIT?
Yeah, thank you, Tilan. Thank you for having me on the show again. So Keppel DC REIT, as I mentioned, is the Asia's first pure play data center REIT. It has been listed on the SGX for close to a decade now. And its portfolio of about 5 billion Singapore dollar consists mostly of data centers in Asia and Europe. Its sponsor is a wholly owned subsidiary of Keppel. And as you know, Keppel has extensive background and experience in digital infrastructure and connectivity. It has a growing pipeline of data centers, as well as it is laying submarine cable and also has experience in power generation. So that's the background on the Keppel data center REIT.
Okay, and why are you calling a buy on this stock now?
Oh yeah, so I think the three main reasons which supports our thesis. First is obviously our TMT specialist Hussaini has a very positive view on the data center sector because of the digitalization, the growing cloud adoption the cloud migration by various enterprises, and as well as AI adoption. So we think that that entails a positive view for the data center REIT as well. The second thing is the support from the sponsor Keppel, which I have mentioned before, and its experience that it has in the data center and the digital infrastructure space. It has a growing pipeline of data centers from about 650 megawatt to 1.2 gigawatt. And finally, we think that all this gives a good visibility on the inorganic and organic growth. Organic, we think that it will have growth from the rent reversions, and inorganic, we think that it has a favorable cost of capital, which should should enable the inorganic growth. Net, we are about forecasting about 5% of dividend growth for the forecast period. So these are the three main reasons which support our investment thesis for the REIT.
Sure. Now, I must ask, I mean, there's all this US policy around AI and data centers. They keep flip-flopping and changing all the time. So how should we think about downside risks to KDC from these?
Yeah, I think that's the key risk. And as I mentioned, it's sort of a known unknown for the stock. But that, I think, how this tariffs, the chip export controls, and the overall AI policy, that is a key risk to look out for the stock. The KDC REIT has a very diversified tenant exposure, and as well as not all the data centers are catered to the AI workload. But if any of the policies are detrimental, then that will be overhang for the stock, especially as the valuations are quite elevated.
Got it. Thanks, Krishna, for that. Now, let's turn to our chart guy. He's got two brand new ideas. First is NANOFILM. Now, He thinks that the NANOFILM's intermediate uptrend looks set to resume after price broke above its downtrend line. So quite a nice looking chart there. So do have a look at that. And you have a lot more details in our newsletter. We also have AEM. Now, this is also trading buy, but it's a contrarian call to a fundamental view, which is actually a sell. Now, our chart guy says that AEM has managed to stay above its anchored VWAP from the 9th of May 2024, signaling that buyers still remain in control. So do have a look at that, especially if you have a contrarian view on AEM. Now, let's quickly look at upcoming events and dates. We've got quite a few results starting with Raffles Medical on the 28th. We've got REIT starting, also Mapletree Industrials Trust on the 28th, and SIA on the 28th as well. The first bank to report, which is OCBC, especially a lot of investors will be looking over to that, particularly with the announced CEO change. That's going to be out on the 1st of August. Now, time's running out. If you haven't signed up for our signal shift and strategy seminar on the 23rd of July, which is this coming Wednesday at the SGX Center. Do join up for that. Spaces are very, very limited. There's me, there's Hagbin, and we also have 3 top corporates and their CEOs who will also be presenting some investment cases for their stocks. These are some stocks that we have handpicked to think that they will be beneficiaries of this whole small and mid-cap wave that is happening in Singapore. So do sign up if you haven't done so already. There'll be free dinner as well. With that, thank you so much for joining us. Have a profitable trading week, and we'll see you next week.